you have been investing in REITs for passive income, then you might have fallen into this trap that people seldom talk about. You see, REITs are essentially like us, home buyers, where we tap into the CPF or bank loans to buy condos. REITs are on a different, higher scale, undertaking hundreds of millions of billions of borrowings to buy the shopping malls or the logistic properties under them, in which they are mandated to pay 90% of what they earn from the tenants as a REIT investor in exchange for the taxation benefits. However, this is where the trap comes in. Because they have to pay up 90% as distributions every time, they're only left with 10% spare cash. So what happens when they want to buy a new property? They either have to take out more borrowings or issue rights from you to get the money. In debt to buy more and more properties to expand your portfolio sounds like a perfect scenario where interest rates are low. However, it's a whole different ballgame where interest rates skyrocket upwards. Under the MAS regulations, REITs can only borrow up to 45 to 50% gearing. And gearing is equals to your borrowings divided by your net asset value, NAV. This means that when your property values keep going down, your gearing ratio keep increasing. And this is where the REIT managers then have to decide if you want to shore up your balance sheet. Do you want to issue more shares at the rock bottom prices or suspend distributions? Which is not a pretty sight. And this brings me to the main highlight of today's video. 8 dividend companies that are good alternatives for passive income. Sounds good, right? Let's dive in. Just want to do a quick shout out for my upcoming Skills Future approved investing workshop happening on 13, 20, and 27 April. Okay, so this workshop is called Intelligent Investing in the Era of Disruption. Okay, so this course is up to 70% subsidized by the government, and you can use your Skills Future credit to deduct the balance. On top of that, this is also accredited by the Institute of Banking and Finance. Okay, some of the course highlights are that we're going to leverage on AI tools, okay, to teach you how to construct your portfolio, get stock ideas, and also help you to save time, especially when it comes to stock analysis. If you're interested to register your interest, you can click on the link here or the link in the comments down below. With that, let's jump back to the 8 dividend stocks. First 3 stocks are our 3 local banks. They have a strong presence in Asia and are rapidly growing in different directions. Like DBS is going India, UOB is Southeast Asia, and OCBC is Hong Kong and China. I especially like how UOB is getting people to sign up for their credit or debit cards by tying up with popular singers like Ed Sheeran and Taylor Swift. Okay, despite talks of an interest rate decrease, which may affect the banks, I believe that our 3 local banks have a good track record of paying stable and growing dividends. Right now, they are giving out over 5% of dividend yields. In fact, I did a video on DBS right over here where it is giving out a bonus 1 for 10 shares and increasing their quarterly dividends going forward as well. So this is the beauty of how your dividends are funded through operating cash flows as opposed to REITs. The next stock that we have is the Singapore Exchange. All right, this is the sole stock exchange operator in Singapore. So they already have a monopoly already. And it provides a platform for trading equities, derivatives, and other securities. So growth prospects wise, SGX is likely to benefit from the growth of Singapore economy and the increasing popularity of their derivative products for the B2B side. Okay, SGX also has a history of paying stable and growing dividends similar to the banks. So in 2023, the exchange declared a total dividends of $3 per share, which translate to a dividend yield of around 3+%. So of course, the dividend can grow moderately in the next few years with the expansion of their products and offerings. The fifth stock that we have is Sheng Siong. Right, Sheng Siong, I believe needs no introduction because it's the leading supermarket chain in Singapore other than FairPrice and Giant. Okay, so it's always located near the neighborhood stores, and right now they have already 50 stores island-wide. Okay, and how they stand out is through their the wide variety of fresh produce, groceries, and more recently they're coming out with more household brands with better gross margins, and that translates to better earnings and better dividends. Samsung has grown the dividend steadily from 2014 onwards and kept the dividend payout ratio at around 70% since 2017. So when the supermarket operator got an earnings boost from the COVID pandemic, Sheng also increased the dividends payout concurrently, where its current dividend yield stands at around 4%. Next up is QF Limited, best known for the Gardenia brand in Singapore. And with the loaf prices creeping up steadily to keep up with inflation, I know because I'm very sensitive to the price whenever my wife asks me to grab one loaf for my kids during the weekends. So this will translate to higher earnings going forward. In fact, they're gonna release better earnings through the profit guidance announcement. Okay, and although their earnings have fluctuated over the years due to the buying and selling of other businesses, they are still free cash flow positive and a track record of paying 5 cents gross dividends, making it an attractive option for income investors. Our number 7 stock, Kim Lee, is one of the largest traditional coffee shop operators in Singapore. Okay, it operates a network of food stores with brands like Kim Lee Dim Sum, Seafood Zi Cha, Tender Fresh, and Tongkichi. And given that Kim Lee is majority owned by their tauges, right, it's natural that they want to pay out more dividends to themselves. And that is where you get to benefit as an investor also. So with around a 60% dividend payout ratio, they are dishing out a 5% dividend yield at the moment. So imagine if you're a Kim Lee shareholder and you go to their store and drink their kopi peng there. You are literally getting a 5% cashback because of the dividends that you're getting from owning their stock. Last but not least, we have our own Hoppa Corporation. Although it is a holding company for the strategic investments in companies like UOB, UOL, UIC, etc., it also has a strong medical goods segment under the brand Tiger Balm. Okay, so the combination of these two divisions have become a stable source of funding over the years. That's why Hoppa Corporation has a consistent history of paying dividends with a payout ratio of around 40%. It even gives out special dividends from time to time, and in June 2023, okay, quite recently, for the first time since 2018, Hoppa actually increased their interim dividend to 20 cents a share compared to 15 cents a year ago. So with that, right, we have come to the last of the video. Do let me know in the comments down below which stock do you want me to dive more in depth. Alright, and if you want to be notified whenever I post a new video, don't forget to subscribe to my YouTube channel and hit the bell notification. Next up, don't forget to check out this video on the 7 stocks near 52 weeks low. And I will see you next time. Thanks for watching and ciao.